Hi everyone, welcome back to the course Financial Mathematics for Actuaries. Now that we have completed the required topic for the course Financial Mathematics for Actuaries, from my portion I have started with the loan repayment method, and just now we have understood the bond management, under which we have understood how to compute the make-only duration and modified duration, and also we have learned convexity. Note that one of the objective of the investor is to maximize their investment return and minimize the risk. Okay, and for this purpose, the basic aim is to minimize the risk, and one way to minimize the risk is the diversifying the investment. So, let us also understand the principle of diversification, and therefore why an investor construct the portfolio, and then we will eventually also understand how to compute the expected return and the risk of portfolio. So let us begin to understand the principle of diversification. Note that this topic is not listed in the syllabus, but it is very important topic as far as the investor manager or investment management is concerned. So, what is meant by a portfolio? Remember, we have introduced the term portfolio in our previous session, but now let us understand what is the portfolio and why the investor actually construct the portfolio. Okay. A portfolio is a bundle or a combination of individual assets or security, right? So it is simply a group of assets such as stocks and bonds, or the stocks of various companies for that matter, okay, actually held by an investor. So the investors is not only investing in one particular asset, he actually diversify, or actually he construct a portfolio of assets so that he can able to minimize the risk. So he can able to invest some proportion of his fund in stocks, or some proportion in bonds, or some, like he can divide it within different types of bonds or different assets. Okay. So what is diversification then? As we have already understood that one of the basic objective of investor is to maximize the return and minimize the risk. Okay. In any point, an investor always want to maximize the return with a minimum risk. So how to minimize the risk is therefore a concern. Okay. And diversification actually will help us to minimize the risk. So what is diversification? The diversification is the process of spreading an investment across assets and thereby forming a portfolio is basically known as the diversification. Okay. So the principle of diversification can eliminate some of the risk. Remember that the risk constitute, or the risk includes the systematic risk and unsystematic risk. Okay. And therefore by diversifying, or by the diversification actually will reduce the unsystematic risk. Okay. The risk that potentially can be eliminated by diversification is therefore known as the specific risk, the unsystematic risk, or sometime we will call the residual risk, and unique risk. Okay. They are all type of risk, they are originated within the company, or the factors that are basically internal to the company. So we must understand the important assumptions of portfolio theory, we have two most important assumptions, okay, under which the portfolio theory works. What are they? They are investors are risk averse. Okay, investors do not want to take risk, okay, unless and until they will be compensated for the return. So, risk averse investors means that, okay, they like to take risk only if they will be compensated for taking such risk, right. Secondly, the returns are normally distributed. Okay. With these two important assumptions, the portfolio theory actually will work, but there are several other assumptions. Okay, our focus is not here to understand the portfolio theory so far, and therefore, okay, let us only understand that investors are risk averse and returns are normally distributed. Okay, then how to compute the portfolio return? Okay, let us take two asset case. Okay, so the return of the portfolio is equal to the weighted average of the return of the individual asset in the portfolio, with the weight being equal to the proportion of investment value in each asset, right. Suppose you have an opportunity to invest your wealth in, let's say, asset X and asset Y. The possible outcome of two assets in the different economy are supposed that given by like this. Okay, so we have different state of economy A, B, C, D, E. So you can think of like an economy under, like so that recession or like a boom, okay, or a stable period or unstable periods, something like that. So we have a five state of economy, and we have the probability that the economy is in a particular state is also given. Okay, so for example 0.1, 0.2, 0.4, 0.2 or 0.1. Okay, meaning that the probability that the economy is undergoing the state of economy as A is 10%. Okay, and with this state of economy, the expected return is suppose computed to be 8%, or sorry, minus 8%, and the expected return on the security Y is 14%. Similarly, given that the state of economy is B, okay, with probability of 20%, then the expected return on X is 10% and the expected return on Y is minus 4%. Okay. Similarly, we can read the other values also. Okay. If this information is given, then the expected return of X and Y can be computed as, okay, simply by considering the expected return, the sum of the expected return, okay, multiplied, we will have like expected return on X can be computed as this minus 8 multiplied by this 10% plus 10 multiplied by this 20%, okay, and 8 multiplied by this 40%, okay, and 5 multiplied by this 20% and minus 4 multiplied by is 10%, or simply you can take the value. These are in percentage term. So we will have expected return on X is computed to be 5%. Okay. So similarly, we can compute the expected return. Okay, given this probability, okay, for Y is we can compute like this multiply. They like 10% multiplied by 14, 20% multiplied by minus 4, or simply we can say like the 14 multiplied by 10%, minus 4 multiplied by 20%, 6 multiplied by 40%, and then 15 multiplied by 20% and 20 multiplied by 10%, add them all and you will get the 8%. So expected return on the asset X is 5% and expected return on Y is 8%. So, asset Y will give us a highest expected return as compared to asset X. Okay. So, in general, we can simply write the expected return as like the probability like the probability time the expected return in given the economy. So, we will have R1 multiplied by P1 plus R2 multiplied by P2, okay, plus we will go up to Rn multiplied by Pn, where R1 is the expected return on X, or sorry, expected return on X here given the economy is in state A, okay, with probability value P1, okay, or simply you can write expectation of Rx is equal to sum of Ri Pi, okay. This is the most easiest formula, okay, or simply it is the average, okay, and therefore sometimes you can call it as like Rx bar also, okay. In the case of two asset portfolio here in our case, okay, the expected return on portfolio is equal to weight of security X multiplied by expected return on security X plus weight of security Y, okay, multiplied by expected return on security Y, or you will call it as like the proportion of money you want to invest in security X multiplied by the expected return on security X plus the proportion of money you want to invest in Y multiplied by expected return on security Y, okay, or simply we will call like expectation of Rp, therefore here is equal to W multiplied by expected or expectation of Rx plus 1 minus W multiplied by expectation of Ry. Since we have only two assets, so if W is the proportion of like fund which is invested in X, then 1 minus W is the proportion of fund that will be invested in Y, and therefore this formula, okay. So, where W is the proportion of money, okay, or proportion of investment in asset X, and 1 minus W is the remaining investment in asset Y. So, from the example above, how much would you earn if invested 20% of your of your wealth in X and 80% of your wealth in Y? Then we can simply like use the formula and compute that the expected return on the portfolio therefore is equal to 20%, okay, multiplied by the 5% what we have got it, plus 80% multiplied by the 8% expected return that you have just computed from for expected for the asset Y, which is equal to 0 which is equal to 7.4%. So, if you invest your wealth equally, let us say 50% in X and 50% in Y, then you can add a, so this 20 become like 0, this 20% become 50%, so it will become 0.5 multiplied by 5% plus 0.5 multiplied by 8%, that will give us the value of 6.5%, okay. What is the advantage of investing your wealth in both X and Y when you could expect a higher return of 8% by investing only in Y? Remember that here if you are constructing a portfolio, that means some amount you are investing in X and some amount you are investing in Y, then you will get 7.4%, while if you are investing in only Y, then you will get 8% return, okay. So, 7.4% is less than 8%, okay. Or if you think of like 50% of your money is investing in X and 50% of money in investing in Y, then you are getting 6.5%, right, which is essentially lower than the expected return you are going to earn if you would have invested your money in security Y only. But remember that investing your entire wealth in Y is more risky, right? Okay, we can see that under an unfavorable condition, Y may yield a negative return of 4%. Remember the table, or remember the table here. Okay, this is the table we have looked at, and where you see that if you invest your money only in Y, then there is a chance, there is a 20% of chance that the economy will be in B, and therefore you will earn a negative return. That means you will become lost, okay, or you will lose some money. You want to avoid this situation. To avoid this situation or this type of situation, okay, you want to diversify your fund or your wealth. Okay, so you will be happy to take 7.5%, right? Be happy to take this 7.4% rather than investing in your 8% or investing in Y and take 8% of return. This is how the diversification will help us to reduce the risk. Okay. Now understand how to compute the portfolio risk and return. Okay. So suppose that in our problem here, 58% or 58% of your portfolio is invested in, let's say, Bharti Airtel stock, and the remainder is invested in Tata Motors. Okay, you expect that over the coming year Bharti Airtel will give a return of, let's say, 13%, and Tata Motors will give a return of, let's say, 19%. So these two examples are purely arbitrary. Okay, we have simply taken, there is nothing to do with the actual like stock value and actual like return you are going to earn. So this is only for the example purpose. Okay, so the expected return on your portfolio is simply a weighted average of the expected return on the individual stock or the individual asset. Okay, the expected portfolio return therefore is equal to 58% multiplied by the 13% return here. Okay, so this 58% multiplied by 13% plus the remaining 42%. Okay, that is 1 minus W. So we will have 42% multiplied by 19% will give us 15.52%. That is the expected return on portfolio if you want to invest 58% of your wealth in Bharti Airtel in our example here, and 42% of your wealth in Tata Motors. Okay, with 13% and 19% expected return from Bharti Airtel and Tata Motors respectively, right? So calculating this expected return seems very simple, or therefore it is very easy. It is just the average. Okay, the hard part is to work out the risk of our portfolio. Okay, and therefore, okay, we will give little time to understand this portfolio risk. So traditionally the risk can be computed using the standard deviation of return or the variance of return. Okay, so assume that the standard deviation of return of Bharti Airtel is, let's say, 33.5%, and the standard deviation for Tata Motor is, let's say, 46.5%. Okay, you believe that these figures are good representation of the spread of possible future outcomes. Okay, and therefore at first you may be inclined to assume that the standard deviation of the portfolio is a weighted average of the standard deviation of these two stocks. Okay, that is 58% multiplied by this 33.5 plus 42% multiplied by this 46.5, which will be 38.96%. Okay, but this will be correct only if the price of two stocks move exactly in the perfect direction or perfect lockstep. Okay, in any other case the diversification principle will reduce the risk below our this figure, right? and therefore the diversification is actually very important to understand. Okay, let us understand the computation of portfolio return and risk. Okay, recall that we have already understood that a portfolio can be described by the proportion of investment fund allocated to each of the security, right? So, for example, suppose an individual invests 1000 rupees in three securities denoted as X1, X2 and X3. Okay, then his security portfolio would be described by the proportion of investment fund, that is 1000 rupees, that he allocates to each of the security. Okay, so WI, therefore this is the weight, therefore is equal to security I investment divided by the total investment. Okay, therefore here if he buys, let's say, 200 rupees worth of one X1 and 300 rupees worth of X2 and remaining 500 rupees worth of X3, then the portfolio would be described in terms of her proportional allocation of W1 is simply like 200 divided by 1000, okay, which is 20%, and W2 will become 300 divided by 1000, that is 0.3 or 30%, and then W3 will become 500 divided by 1000. This is very easy. Okay, so WI is the weight. Okay, and the weight is being computed as the total investment together. Okay, so the security I investment as a percentage of total investment. Okay, right. Note that the whole must equal the sum of the part. That is, the proportion of investment funds allocated to each security must sum to 1. We have already understood this. The sum of WI is equal to 1, okay, where N is the number of stocks in the portfolio. So, whatever like weight, this weight actually will depending upon 0 to 1. Okay, so the WI must be positive. Okay, so the allocation of weight WI can take on any value. Okay, so meaning that you will prompt to ask whether this WI can be negative. While I said that this value is expected to be 0 to 1, then can the value will take negative? The answer is yes, the value can take negative too. Okay, if WI is negative, then this means that there would be a negative investment in security I. Okay, what does this means? A negative investment is the opposite of an investment which is borrowing or selling the stock short. Okay, so the investor may be short selling. Okay, so in this case the negative weight can be interpreted as a short sell, okay, in which the investor use the proceed from the sell to invest in the other security in the portfolio, right? So like when we understand that the weight should be in between 0 and 1, sometime the weight can also be negative. In such case, we understand that the investor may be short selling. Okay, what do you mean by a short sell in the stock market or in the financial market? Short selling means, okay, whenever you are predicting that some asset price is declining and therefore you want to take that advantage. Okay, let us understand it in this way. Investor can sell securities they don't own. Okay, so you can even sell the securities even if you have not owned the security. That means you will borrow the security and you can sell it, right? So selling a security now and buy it later. is actually short sell. Okay, so the short seller expect to share the expect the shares or the stocks to decline in value and wish to profit from the decline, right? So to implement this strategy, the investors borrow the security, as I have already told, sells it in the market and then repay her debt obligation by buying the security later and returning the borrowed share. Okay. So to profit from this short sell, remember that the securities price must decrease. So whenever you are predicting that the security price is going to decrease and you want to take the advantage but you don't have the security, then you can even borrow the security for the time being and sell it, okay, in the condition that at the later stage you are buying back the security, okay, at the lower rate, and therefore you pocket the profit, right? Let us understand this in the following example. So, for example, suppose an investor sells ABC stock short by borrowing one shares and selling it in the market for, let's say, 1000 rupees. Okay. So, if the price of the ABC stock declines, let's say, to 5 500, okay. So, this share is currently selling at 1000 rupees, but you are predicting that it will be decrease in value. So, in the future it will become 500 rupees. Then the short seller could repay his obligation, okay, by buying back the stock in the market at this 500 rupees and returning the borrowed share, okay, and therefore the net profit will become 500 rupees. Okay. However, if the price of ABC stock increase rather than decrease, then the investor may suffer a huge loss. Okay. Then let's say, for example, if the price of the ABC stock increase to, let's say, 1500, okay, and short seller has to cover, then, okay, he would lose a 500 rupees, right? So, to continue our discussion here, okay, suppose an investor with 10,000 rupees of investment fund also sells rupees 5,000 worth of stock 1, okay, short, that is borrow the shares, okay, of stock and sell them in the market for, let's say, this 5,000 rupees and use the proceeds along with the 10,000 to invest in the stock 2, okay. So, its portfolio can be described as consisting of two stocks with allocation of W1 will be equal to minus 0.5 and W2 is equal to 1.5. Okay. So, what we have seen here that the weight can therefore be, the weight can take any value, right? So, it may go beyond 1 or it may go below 0 also. In such case, the investor is actually like doing the short selling activity. Okay. So, in this case, we have computed W1 to be minus 0.5 as this minus 5,000 divided by 10,000. So, stock 1 investment divided by total investment, okay, which is equal to minus 0.5. So, W2 therefore is equal to stock 2 investment, okay, divided by total investment, that is 15,000 divided by 10,000, which is equal to 1.5. So, W2 is 1.5 here and W1 is minus 0.5. Okay. So, I believe you have understood how the short selling works, okay, and what is the weight. Okay. Of course, we will have W1 plus W2 is equal to 1, right. So, here W1 and W2 is equal to 1. The sum therefore should be equal to 1. Let us come back to the portfolio return. The portfolio rate of return is the sum of the weighted rate of return of the security making up the portfolio, with the weight being the proportion of investment funds allocated to each security, right? And therefore, the expected return of portfolio is simply, as I have already mentioned it there, okay, sum of WI RI, which is equal to W1 R1 plus W2 R2 plus up to we will have WN RN. Okay. So, if the investors allocate 20%, 30% and 50% of his 10,000 in stock 1, stock 2 and stock 3 attained a rate of return of 10%, 5% and 15% respectively for holding this stock for 1 year, then his portfolio rate of return would be 11%. Okay, that is here RP. The portfolio rate of return is this 20% multiplied by 10. Okay, that is this 10%. Okay, so 20 multiplied by 10 plus 30 multiplied by 5 plus here 50 multiplied by this 15. Okay, will be 11%. We have computed the return, but we are actually talking about the expected return. As we noted in our discussion of security return and risk, investors are concerned not with the past returns but with the expected future returns. Okay, returns are computed today, okay, assuming that the what the investor expect to get it, right? So, the expected portfolio rate of return is the sum of the weighted expected rate of return of the security making up the portfolio, and therefore, we can have expected return, okay, or expected return of the portfolio will be sum of WI, okay, expected RI, okay, or we will simply have WI, okay, multiplied by expectation of R1, or W1 multiplied by expectation of R1 plus W2 multiplied by expectation of R2, and we will go up to WN multiplied by expectation of Rn, where this Ri, okay, is equal to, or Ri is the return. Okay. So, let us now also understand how to compute the portfolio risk. Okay. So, investment risk can be measured by the variance and the standard deviation in the securities rate of return, as I have already mentioned. Okay. So, the risk can be computed using the variance of the return and the standard deviation of the return. Okay. So, this measure of risk is also appropriate in measuring the risk of portfolio. Okay. So, note that the portfolio's variance or the risk would depend not only on the variance of the individual stocks that make up the portfolio, but also on the correlation between the stocks composing in the portfolio. Okay. So, the risk not only dependent upon the variance, okay, but also it will depend upon the correlation between the two assets, okay, or between the assets that compose the portfolio, right. So, let us now derive the portfolio variance, okay, as VRP. Okay, let us start with the definition of variance here. What is the definition of variance? Just recall, we will rewrite this as the variance of RP is equal to expectation of RP minus expectation of RP square. Okay, this is the variance formula, right. Okay, for simplicity, assume a two security portfolio again. Therefore, we will simply have like expected return of portfolio is W1 R1 plus W2 R2, and okay, the portfolio variance therefore can be expressed as the variance of RP is equal to expectation of W1 R1 plus W2 R2, okay, minus W1 expectation of R1 minus W2 expectation of R2 square, okay, using this same formula. Okay, using this formula I have written it in this way, right. So we have here variance of RP is equal to expectation of W1 R1 plus W2 R2 minus W1 expectation of R1 minus W2 expectation of R2 square, okay, or we can simply write it as, okay, VRP is equal to expectation of W1 by, and then we will have R1 minus expectation of R1 plus W2 R2 minus expectation of R2, right. So what we have observed here, this equation just look like, okay, the a and a plus b whole square, or in we will call it as ab plus cd whole square, which is just equal to a square b square plus c square d square plus 2 abcd, right. So it look like this. So using this formula, therefore we can simply rewrite this variance formula as this one, okay. So VRP is equal to W1 square expectation of R1 minus expectation of R1 square plus W2 square expectation of R2 minus expectation of R2 square, plus we will have here 2 W1 W2 expectation of R1 minus expectation of R1 plus multiplied by R2 minus expectation of R2. I am so sorry, okay, or we have the very, like we can simply rewrite this as, okay, in terms of covariance. So you can write variance RP is equal to, okay, W1 square V R1, okay, this is simply the variance formula, okay. So we will have here like variance of R1, okay, W1 square multiplied by the variance of R plus W2 square multiplied by the variance of R, and then we will write again like this one 2 W1 W2 as it is here, and this portion is nothing but the formula for covariance between x and y, or covariance between R1 and R2, okay. Remember the covariance formula here. Covariance between x and y is equal to expectation of x minus expectation of x multiplied by y minus expectation of y, right. The same formula is here used. So in terms of covariance, we will rewrite this formula as this one, okay, or this is the variance formula. In terms of standard deviation, we will simply take the root over of it, right. So we will equal root over of this one, okay. So standard deviation of portfolio return therefore can be computed as this one, or you can simply take this, okay, W1 square V R1, okay, plus W2 square V R2, okay, plus 2 W1 W2 covariance between R1 and R2, okay. We will simply have it like 1 upon the same, right. So this is how we will compute the expected return of the portfolio and risk of the portfolio, okay. I believe you have understood this, okay. Now use this formula, okay, and you can take your own numerical example and proceed.